Are you ready to delve into the intricate world of financial performance assessment? This video will guide you through understanding financial statements and key ratios. Learn how to evaluate profitability, efficiency, liquidity, and solvency.
Financial statements are vital tools for assessing an organization's financial health. The income statement reveals the company's revenues and profits over a period. The balance sheet provides a snapshot of assets, liabilities, and equity. The cash flow statement details cash inflows and outflows. Together, they offer a comprehensive view of financial performance. Financial ratios are essential for analyzing a company's performance. Profitability ratios measure profit relative to sales, assets, and equity. Liquidity ratios assess the ability to meet short-term obligations. Efficiency ratios evaluate asset utilization. Solvency ratios measure the ability to meet long-term obligations. These ratios provide insights into financial health. The income statement analysis begins with revenue growth over periods. Cost management involves evaluating goods sold and operating expenses. Profit margins like gross and net margins reveal profitability. Revenue trends and cost efficiency are key. This analysis helps stakeholders make informed decisions. The balance sheet analysis focuses on asset management and liability structure. Current and non-current assets reveal financial stability. Liabilities, both current and long-term, indicate financial obligations. Shareholders' equity shows the company's net worth. This analysis aids in understanding financial position. Cash flow statements track cash from operating, investing, and financing activities. Operating cash flow shows core business cash generation. Investing activities reflect capital expenditures and investments. Financing activities detail debt and equity changes. This statement reveals cash management efficiency. Profitability ratios like gross profit margin and net profit margin are crucial. They measure the company's ability to generate profit. Return on assets and return on equity assess efficiency. These ratios help in understanding profit generation. Stakeholders use them to evaluate investment potential. Liquidity ratios assess a company's ability to meet short-term obligations. The current ratio compares current assets to liabilities. The higher ratio indicates better liquidity. Quick ratio excludes inventory for a stricter measure. These ratios are vital for evaluating financial health. Efficiency ratios evaluate how well a company uses its assets. Inventory turnover measures how quickly inventory is sold. Accounts receivable turnover assesses credit sales collection. Asset turnover evaluates revenue generation from assets. These ratios indicate operational efficiency. Solvency ratios measure a company's ability to meet long-term debts. The debt-to-equity ratio compares total debt to shareholders' equity. A lower ratio indicates less leverage. Interest coverage ratio assesses the ability to cover interest expenses. These ratios are crucial for long-term financial health. Begin by analyzing the income statement for revenue trends. Examine the balance sheet for asset and liability management. Evaluate the cash flow statement for cash efficiency. Calculate financial ratios for profitability, liquidity, and solvency. These steps provide a thorough performance evaluation. Benchmarking involves comparing financial ratios with industry averages. It provides context for performance evaluation. Identifying trends over periods is crucial. It highlights strengths and areas for improvement. This comparison is essential for strategic decision-making. Non-financial factors also impact financial performance. Market conditions influence revenue and costs. Management quality affects operational efficiency. Competitive position determines market share. These factors provide a holistic view of performance. They are crucial for comprehensive assessment. LO's financial performance is assessed through statements. Revenue growth and cost management are analyzed. The balance sheet reveals asset and liability structure. Cash flow analysis shows operational cash generation. Financial ratios provide insights into profitability and solvency. Comparing financial statements of different organizations reveals insights. Revenue, costs, and profits highlight operational scale. Asset and liability analysis shows financial stability. Cash flow comparison indicates cash management efficiency. This comparison aids in strategic planning. Revenue and costs determine profitability. Asset and liability management indicate financial health. Cash flow analysis reveals liquidity and operational efficiency. This interpretation aids in strategic decision-making. Ethical financial reporting ensures transparency and accountability. Organizations must provide clear and accurate information. Integrity in reporting builds stakeholder trust. Compliance with legal standards is essential. Ethical practices enhance reputation and sustainability. Accounting concepts guide financial statement preparation. Historical cost principle records assets at purchase price. Revaluation reflects current market value. Impairment adjusts for non-recoverable assets. These concepts ensure reliability and comparability. Valuation methods affect financial statements. Inventory is valued at cost or net realizable value. Depreciation allocates asset cost over its useful life. Straight line and reducing balance are common methods. These practices ensure accurate financial reporting. Handling irrecoverable debts involves recognizing bad debt expense. Provision for doubtful debts estimates uncollectible receivables. These practices align with the conservatism principle. They ensure financial statements reflect true asset value. Accurate provisions are crucial for financial health. Financial statements meet diverse stakeholder needs. Investors seek profitability and growth insights. Creditors focus on liquidity and solvency. Employees look for job security and resource investment. Compliance with standards ensures transparency and trust.
In conclusion, these practices support informed decision-making and contribute to long-term stability. Thank you for watching this video. If you have any questions, please feel free to contact us via WhatsApp on 074 8436 1688.